All right, let's start the class. So today we are going to start on topic 5, right? And then we have some other important things to cover. So there's some repetition in topic 5, some of the IT. So this is basically IT, employment. So the last few weeks we have covered this. So we have the trading losses, just a couple of slides, just the offset idea, and then we do self-assessment is mostly a repeat. And then this is the only new topic really here. So let's look at this, basic awareness only. Yeah, so if you have a trading loss, you can offset it. That's the main idea here. So you can offset this against other income or gains. So slight difference from the property income losses. If you remember the property income loss treatment that we did, when you have property income losses carried forward, only the commercial can be carried forward, commercial losses, and then you can only set that off against future property income of that same business, not other types of income. Here, trading losses you can set off against other types of income, because it's basically your, it's your main income. So different type, basically offsetting the trading loss. So we're not going into the details of that. That ends the thing, okay? That ends the trading loss treatment, okay? This is very important, okay? I think you have one of these questions in your Bob also, question number 30, Bob. I think the part 2 has these kind of questions on when does he have to file the return. So all this return, this is very easy marks to pick up. Just memorize this system. Payment dates and the return filing dates, those kind of things, just memorize, because you always get narrative questions, and be prepared for narrative questions in your exam as well, in your test as well. So all the topics that are there on wherever, you can look at the textbook and you can figure out what are the narrative questions possible. So that's why, so if since you have the textbook, you can see, for instance, this could also be a narrative question. What types of, this is in topic number, this is topic number 9, chapter 9 actually, self-employment, okay? So under self-employment, so you have, these are all the things which are disallowed, okay? These illegal payments. Now what is disallowed? So all these could be technically narrative questions, like what are the things that are disallowed? So then you'll discuss illegal payments, fines, all those things which are disallowed. And it's actually already a part of your, so you should store the knowledge in your brain like that, okay, you have it as a block of things which are disallowed, things which are allowed. And then anyway, when you're doing the questions, like I'll be discussing question number 9.7 with you, and in 9.7 you find that you have to, basically, it's like your brain is like a computer and it's calling the RAM blocks. So one block of RAM is just what is disallowed. And you know that when you're adding back, when you're doing self-employment trading income, you have to add back items which are disallowed. So then you just call back what are the things which are disallowed. If you see it in the question paper, then you just add it back. So you're already using that knowledge, but you also just have to kind of have it in your brain, and that's how you'll remember it, as a block of, okay, these are the things which are disallowed. Now this could also be a narrative question of maybe 2-3 marks or something. List all the items which are disallowed for self-employment trading income, things like that, okay? So when you look at the textbook, you can figure out what could be the items that are disallowed, okay? So I mean, what could be the item, anything that has a listing like this, all the fines and penalties, whatever's not allowed, okay? Bad debts, okay? General provisions for bad debts are not allowed, okay? Those things, but specific ones are allowed. Then what is allowed? That's also, you see there's a long list here, what is allowed. All these can be, so these should all be stored as, so you have to anyway memorize this stuff. You need to know it by, and if you do many examples, you don't have to actively memorize it, you'll automatically remember it. So interest, okay, patent royalties, pre-trading, some of this is listed in your slides, but since you have the book, it is important. This is the kind of information that really does not get dated from year to year. Some of the percentages and all, as I told you, very careful, because we're using an older version of the book. So the percentages and the rates and all, always take it from the tax tables or from the latest version of the slides. But things like this, like what is allowed, what is not allowed, okay? So all these things like legal and fees incurred, etc., etc. So all these things, which these are not likely to change from year to year. So the book is still very valuable, even though it's a slightly 1 year old edition. It is still valuable for all this narrative material. Okay, and then what we discussed, like, you know, badges of trade, how to identify employment, income, self-employment, all those things, those kind of theoretical matters. Okay, so anyway, so I'm just going to keep it at short lease premiums because I'm going to discuss that later. So maybe I can actually make this full. All right, let's go back to this. So dates of payment. So now that I've told you all this stuff, okay. Okay, so what are the things you have to do? If you have, like, sometimes, as you know, payee, which we call, I'm just calling it payee, P-A-Y-E, and that's a form of tax deducted at source. There are many other forms of tax deducted at source. That's a more general concept, and payee is one type where the employer deducts your salary at source and gives it to the tax authority, right? So like my salary from Duffy is, Duffy will already cut the tax, and they will directly pay the tax to the tax department, and they'll give me the net amount. So that's an example of payee. Okay, in China you wouldn't call it payee, you'll call it something else, but the idea is the same. Right, so but if you have other sources of income, okay, you have basically, okay, let's look at the return dates first. So this is the kind of stuff that you have to memorize, okay? Paper return deadline, and then the electronic deadline. These are the kind of things. I think this is the question in question number 30, Bob, part 2. So you already have the answer to that in the here. So this year's, whatever the dates are for this year, I think better than mechanically memorizing it, you should memorize the system, and then based on the year, and then you can also, as a shorthand, because in your exam you're only dealing with 25-26. You're only dealing with tax year 25-26, so you know the exact dates that you need to worry about. But it's better to have a general sense of the rule. What is the rule? That is basically, this is the rule that you should actually remember. 31st October after the end of the income tax year. It's important to remember the general rule also, because in case you forget the date, actually, you can remember it like this. 31st October, you might remember this one, and you might forget. You don't know what your brain will be able to recall at a point of time. Sometimes you can recall one thing and you can't recall the other thing. So it's better to learn the general principle as well. So 31st October after the end of the tax year. Okay, so, and then 31st January after the end of the tax year. Okay, this is for electronic filing. So that means that if you apply these rules for 25-26, when does 25-26 end? We may need this information later on as well. Oh, I don't have it here. But 25-26, 35, we'll just write it somewhere else. We'll just write it. So this one is, maybe we can write it here when we are doing your topic 5. We can just write it here. So just as a block, we'll write it here. So this tax year 25-26 is starting on 6th April 20, I'm just going to write 26, okay? Starts on 6th April 26 and ends on 5th April, 25-26, it starts on 6th April 25. Let me just make this 25. Starts on 6th April 25 and ends on 5th April 26. All right. So based on this, we can actually work it out. What is it? 31st October after the end of the tax year, and 31st January after the end of the tax year, right? So this is what the rule says. We just apply the rule. 31st October after the end of the tax year, and 31st January after the end of the tax year. These are the tax return filings. So this will lead you to after end of April 26, so 31st October 26. So I'm not writing this down because it will take me too much time. So this will become 31st October 26, and it will become 31st January 27. This is clear for this year, okay? And that's what you have. So I think you should practice it once. Read the general principle. The way you learn, I think it's better to learn this way instead of just memorizing the final 2 dates. I think that's too risky. I think you should practice a little bit. Just read the rule, understand the rule, can mentally map the rule out, and then apply the rule like I'm doing here. And only thing, what I'm not doing, you should do it. You should mentally go through the process and then write out the dates. Then that will embed the idea in your head, because you can easily get questions on this. Okay, as you see in the case of Bob. Right, so write it down, and then, then automatically you remember. And then additionally, as a shorthand, you can also remember the direct dates. So that's it. So you get 31st January. From that, you can see from there that, what do you end up with? Electronic is 31st January 27, and paper is 31st October 26. Okay? And then there are all kinds of penalties. So penalties, I would say, are secondary importance in terms of things to memorize. The dates and dates of payment and the dates of filing returns, I would say, because there's so much material to memorize. It's not humanly possible to do it. So it's better to have some kind of priority arrangement. Okay. So first priority, second priority. So I would say first priority is the dates of payment and the dates of filing the return. And then a second priority, if you can, you try to remember the penalties, okay? So it's all a matter of just having, unfortunately you don't have time, as you can see how tight the whole semester is. Actually, a subject like this, we should not have a tight semester when we have a subject like tax, which is just so much material. So the other point of you have to know is this, within 6 months of the end of the year, if you have any other kind of income, like if all your income has been deducted through payee or other kinds of tax deducted source, then of course HMRC already knows, because the tax payment is already going to them under your name, so they know that. But if you have any other kind of income which HMRC would not be aware of, you have to inform them that I have other income, and I will be filing a return, etc. So that you have to inform them. Okay. Here, this is just interest and penalties. So this one I won't spend too much time on it. This is just mechanical stuff which you have to memorize as a secondary, I would say, as a secondary priority. So there's nothing much for me to explain here. Mostly just all kinds of liabilities. Okay. So we will come to the NIC, NICS, we call it NICS. NICS is just the national insurance contributions. So various types of, and there are various classes of that, so we will study that. But anyway, so that has to be added to the income tax. You already have some idea of NICS from your last semester's case, ready mix concrete versus Minister of Pensions and National Insurance, which we did under employment law in the last semester. Why was that case? Because ready mix concrete wanted to show those guys as independent contractors or self-employed people. It's basically around the same thing approximately. So today or this semester you're studying self-employment income, and there you can see the badges of trade, and then there's also the idea of employed versus self-employed. So it's the same idea that you saw in the previous semester in the employment law section in that RMC versus MPNI case, right? Where the employer tried to designate those guys as independent contractors. And why were they doing that? Because as you will see later, that you've already seen this, right? In the case of self-employed, there are certain benefits that they have. All these there will be a lower burden of paying the national insurance contributions. The employer doesn't have to pay it, and that's the same motivation. You should also remember why we have this case going up to the California Supreme Court, where Uber and Deliveroo and all these Uber Eats and all these guys, they won, the food delivery companies and the rideshare companies, they won the case in the California Supreme Court. And again, that's the exact same motivation. The same motivation that you saw in that last semester on that case. They wanted to basically, if you have somebody shown as independent contractor, then the pension liabilities on the company are less, and there are other kinds of benefits as well. So the companies will generally try to show them as independent contractors. Self-employed people also have some benefits of their own, so they also want to be self-employed. Like you saw in the topic 2 of this semester, in this module, when we were doing tax avoidance, we saw these things called these personal service companies, right? Why were they setting it up? Like a BBC presenter, instead of being an employee of BBC, sets up a company and then sells the services of anchoring to the BBC, so that then they have an advantage in terms of insurance payments and all that. So you're already familiar with the idea of NICs. It's an additional pension payment, and from next year, next academic year, we're starting in China also. There is a insurance payment scheme that is starting, as you should be aware, right? There will be an insurance deduction from your salary whenever you work, whatever amount it is. A certain percentage of your salary will be deducted for the pension payment. Right, so now you have to pay, there are payments to be made. These are the dates you have to remember as well. Okay, so you have also income and class 4. Now, class 4 is for the self-employed people, so we'll come to this, there are definitions of this. But basically various categories of NICs. So you have, now you see you have to remember these dates. Payments on account. So there are 2 dates of payments on account, and there is 1 date of a balancing payment. So in the case of filing, there are only 2 dates. There's only 1 date, depending on what type you're using. If you're paper, then you're 31st October after the tax year. If it's electronic, then 31st January after the end of the tax year. And in the case of payments, you have 2 payment on account dates. 31st January in the tax year. Okay, 31st January in the tax year, and 31st July following the tax year. Okay. These are the 2. So 31st January in the tax year, 31st July following the tax year, and each of them has to be 50% of the income tax and class 4 NICs due for the previous tax year. Because the reason they're referring to the previous tax year is that the income and the tax liability for the previous tax year is already known to you by now, because you're already filing at the end of your making the payments at the end of, almost towards the end of your tax year and after the end of your tax year. So this 31st January and 31st July, by this time you already know this information. So that's why they're saying take 50% of whatever was due last year, and then just make that as a POA, 50% each. And then balancing payment or a repayment, okay, will be due on 31st January following the end of the tax year. So there's 31st July, so don't get these dates mixed up. The 31st July is for the payment on account, and the 31st October is for so read the question carefully. Sometimes I've seen students write 1 date. When the question is on payments on account, they write the date for filing the return. Okay, so you have to remember, because the date for filing the return is 31st October, whereas the payment on account is 31st July. So make sure you remember these dates clearly, because these are easy ways to pick up like 2-3 marks, and all the marks every mark makes a difference. Okay, then you have a balancing payment on 31st January following the end of the tax year. So this is actually similar to your, if you see your tax, you see the tax payment date, the 31st January is this similar point. Okay, so is 31st January is the balancing payment. Balancing payment means that because you made the payments before this, the 2 POAs, the 2 POAs are based on your tax liability for the last year. And so if you find by the time you come to 31st January, when your tax year is already over, right, so then you have a better idea of how much income you have this year. So maybe you find that your 2 POAs did not fully discharge your tax liability, so you still have some positive amount of tax payable. In that case, you have to make that residual payment, the balancing remaining payment on your tax, based on your tax liability, at using the balancing payment. So if you have any class 2 NICs or capital gains tax, you have to add it to the balancing payment. Class 2 NICs are actually now gone, right? So now you can see using the same principle. Now we've got both the information on the same slide, which is that you have 31st January in the tax year. So remember, our tax year now is running from the 6th April to 5th of April, 6th April 25 and 5th April 26. So that means 31st January, there is no 31st January here, you already missed that. There's one here, okay, in 26. So that means in the tax year. So 31st January in the tax year means just before the end of the tax year, you make a payment. That's on 31st January 26. And then after the end of the tax year, which is 31st July, you make another payment, and the balancing payment will be 31st January 27. Is this clear? So just practice these a few times. This is important information to remember, because you can easily get this in a question, both in the class test and in the in the final exam. Okay. Now there are certain reasons why this may not be required. Okay, so this also is, I think, important, but maybe it's a secondary importance. That if last year was your dues were less than 1,000, or if more than 80% of your dues, it's actually not that difficult to remember, so you should probably remember it. That is less than 1,000. If you had a less than 1,000 liability last year, and more than 80%, or more than 80% of the liability for the previous year was satisfied by deduction at source. That means whatever you had as a liability last year, if more than 80% of that was taken out by payee or some other kind of TDS, then also you don't have to you don't require the POAs. You just require the balancing payment. And you can also request this. This is just an administrative matter. You can just, if you have a balancing payment less than 3,000, you can ask your employer to collect it by the payee system. That way you don't have to make a separate payment. Okay. Yeah. Now this is the part where you just balancing payment is the POAs do not have penalties, but balancing payments have penalties. Okay. So I would say this is a secondary importance for memorizing, but everything that's there in the slides, and in fact beyond that, even everything that's there under a topic in the textbook, you should actually remember, because everything is not mentioned in the slide. Like if you look at the, when we're looking at that particular section of the textbook, when we are talking about all this stuff, you'll find that all of these conditions are actually not written in the slides, because maybe, there's not enough space or whatever. So, or maybe the MC did not think it was that important, but you could technically get, since it's an ACCA paper, technically you could get questions on anything that's mentioned in the textbook. Okay. So anyway, so all this stuff. So therefore, since you have the textbook, as I said, these kind of potential narrative questions, or list of what is allowed as a deduction, what is not allowed, all these things, you should prepare separate notes on that yourself. If you prepare the note yourself, it'll actually make it easier for you to remember. So anyway, so everything that's here is technically examinable. Right, so this is now no point my reading it out. This is just a rule, okay? So you just have to remember it. So this, I'm not going to spend too much time on this. There's nothing to explain here. So there's no penalty for POAs, but there is a penalty. There is still interest charged on POAs if you pay it late. Okay. So this is all common sense. If your penalty is also paid late, then you will also get. So if you have overpaid income tax, you will get interest on it, but there is what is called a bid-offer spread here, right? So here we have something. This is like a bid-offer spread. So when you go to the markets, if you go to what can I say? You basically, I think we don't want to, because we are tight on time, so I'm not going to spend time on this. But I'm just mentioning it since it's recorded. That is, this is basically what is reflecting is this is a bid-offer spread. that whenever you're dealing with, in this case, the HMRC is acting as a dealer. In any market, when you deal with a dealer, right, you always deal on the worst price. So when the dealer buys from you, he will, like I can just give you a quick example of a bid offer spread, which is if you go to the bank and let's say you're buying US dollar, you're going to the US for a holiday, okay, so maybe the price is maybe 6.825, okay, and it is maybe 6.855, okay, just as an example. So if you go to the bank and you want to buy US dollars against RMB, you will find that the prices are like this, okay. We can actually make this also bigger, so we can make it, yeah, I think this is good enough, okay. So I think you can see, yeah, so if it's 6.825 and 6.855, that means that if you want to buy US dollars by selling your RMB, you will have to pay this price, okay. You have to pay the more expensive price, okay. You have to pay more RMB. This is showing you RMB per US dollar. So you have to pay more RMB per US dollar if you want to buy something, right? If you want to buy this is a dollar is the base currency here. And you can listen to this semester in international finance. We are covering all these exchange rates and all these things. So since you have access to the student folder, you can look at the lecture videos for international finance as well. It will be useful for you. You should know about these instruments and all that. So anyway, so this is, you are paying a higher price. But when you come back from your holiday and you have excess US dollars, when you want to go back to the bank and sell it back to the bank, he's not going to give you, assuming the price has not moved in that time, he's not going to give you you can't sell it at 6.855. You sell it at 6.825 because this is his bid price and that is his offer price. So his price for buying, so whenever the market maker or dealer is quoting a price, there is something called a bid offer spread. So this is called a bid offer spread. You should know this term. It's called a bid offer spread. And the bid offer spread here is, well, it's all mixed up with other things, but the bid offer spread here is actually this minus, this is the bid offer spread. Okay, so maybe I can give it the same color so to understand what is a bid offer spread. Right, this is the bid offer spread and this is the bid, and this is the bid and this is the offer. So these are terms you should know about. As I said, finance, accounting, law and economics, they're all actually connected. So anyway, so this is basically just, so I'm just showing you this additional knowledge here about a related subject. So this is the bid offer spread and you're seeing the same thing here. So you should also get in the habit of seeing similarities between different ideas. So you see the HMRC applying its own bid offer spread here, that when you have paid excess tax and there's excess tax sitting there due to you, on which they will pay you interest, but that interest rate is lower than the rate of interest charged on the overdue tax. So if you're late on your payments and they're going to charge you interest rate penalty on that, and that interest rate, well, not penalty, but let's call it the interest rate on the overdue tax, that interest rate is going to be higher. So there, in this case, it will be something like, maybe in the case of this will probably be like maybe 5%, okay, if you have extra money, and then they'll charge you 7%, okay. So here they'll charge you 5%, they'll pay you 5% when you have overpaid the tax, but when you have underpaid the tax, they'll charge you 7%. So they're also applying their own form of bid offer spread, okay. This is how all the dealers and the market people who make markets, who are the dealers, this is how all of them make money, by buying at a lower price from the public and selling to the public at a higher price. So the HMRC is doing the same thing, okay. We lost a little bit of time, but you learned about an important allied concept, related concept in finance, which is the bid offer spread. So you see that here as well, this penalty, you can just, I'm not even going to spend time on this, you can just see if you have time. Second priority, I would say, if you have time, try to memorize it, because theoretically you could get a question. All this stuff, I'm not going to waste my time, just information. You can read it because we have very limited time, so I need to spend the time on things that need to be explained. Okay, so if we have time, we'll come back to these penalties. Whatever, okay, this is not yet in place. Making tax digital is not yet in place. So in that sense, the UK is quite far behind actually, because most countries have already gone fully digital like more than 10 years ago. So here you have our main topic for today, which is NICs, right? The different classes. This is your top table of contents. Okay. So what we need to remember, we are mainly concerned with Class 1 NICs and Class 4 NICs. 2 is already gone, okay? And 3 is, okay, it's there, but we are not really discussing it. Now, where can you find information on this? If you see here, okay, this is here. Then maybe we have the tax tables somewhere else. What can I do here? I can actually just load the tax tables. Where are the tax tables? Here. I can just load the tax tables here. Let's look at the tax tables for NICs. Okay, you can already see what's available. So most of the things are in the tax tables. So you don't have to memorize it because it will be given to you. Even in your class test, you get the tax tables. So you can already see from the tax tables what kind of NICs we need to worry about. So we don't have to worry about the class 3 NICs because they haven't even given you the percentages there. And class 2 is already abolished. So as I said, it's mainly class 1 and class 4. So what you need to do is really to remember what is for what. Okay, so I've tried to highlight this a little bit in the notes, but it's already there. The information is there in the, so if you look at your notes now, here, this is topic 5 notes. Okay, here you can see that, yeah, so class 1 NICs, employees, I think maybe a little bit easier to see because there's so much light in the room. And maybe the, but actually that one also has a dark background, but this is more information. So NICs are payable by, for in relation to employees. Then the employees will pay the primary class 1 NIC, so you should remember these things. You need to remember these definitions, okay? Because when the question comes, if you don't know what is what, who pays what kind of NIC, then you won't be able to answer the question correctly. So you need to know this, that the employees are paying the primary class 1 NICs, okay? And so this is one of the reasons. So now you see why the BBC presenter wants to set up their own company, because they don't have to pay, in that case, they're not an employee, and they want to set up a personal service company and sell their services to the BBC, because then they're not an employee of the BBC, and then they don't have to pay the class 1 primary NICs, okay, or primary class 1 NICs. They don't have to pay, so less of a tax liability. Okay, so it's actually not tax, it's actually insurance, but it's, you can think of it as any money that you're having to pay to the government. Whether they call it tax or insurance, doesn't matter. So yeah, so this is one. So so this one, employers are paying what is called, the employers pay the secondary class 1 NICs. Okay, and so therefore you know, you need to know who has to pay what, so that you know where to look in the tax tables here. You know, so the rates are all given, but you should know which rate to look for in a particular question. Okay, because they will not. Okay, let's look at it here. Okay. Right. So it depends on the employee's earnings. It's slightly different from the taxable income, because the taxable income is given a lot of benefits, etc. So the employee's earnings are calculated in a different way. So we don't have to worry so much about that. Mainly, we need to worry about, first priority is to understand what are the different types of NICs. Okay. So under class 1 NICs, you have various categories. So you have the, maybe we can put this right now next to each other, and then we can go to other things. Yeah, so you can see here class 1 primary, class 1 primary, class 1 secondary. Then you have class 1A. This is for what? This is for the, no, where is this? Oh yeah, we have to go, now we can use the textbook, okay? Class 1 NIC, so let's look at the details, yeah. Okay, so these are NICs. Now, let me just look at the, yeah. So this is just this information is already in the tax tables, right? Primary class 1 contributions. What was the point I wanted to show in the notes? Yeah, so we already explained this. The primary class 1 NICs are paid by the employee. Secondary class 1 are paid by the employer. Okay, employers are paying this. Then there's a third category under class 1, which is class 1A NICs. This is payable by the employer. Okay, but it actually relates to the BIKs that the employee is getting. Okay, so if you already done BIKs under employment income, right? So the BIKs, if it's not convertible into cash, and most of them are not like that, so therefore you don't have to pay the class 1 NICs on the BIK. So like primary class 1 NICs payable by employees, that does not consider the BIKs. So the BIKs are excluded. So you have an interest in maximizing your BIKs, and that's why, if you remember, we studied something called a salary sacrifice scheme. So if you go for the salary sacrifice scheme, then there is also a second liability on that, class 1B, but I don't think they have mentioned that in the income tax tables. So class 1A, so we don't have to worry about that so much, because it's not there in the tax tables. Means you're not going to get a question on that, most likely. Okay, so that becomes the second priority at least. So you can see that we have to worry about this. The class 1A is the third definition we need to worry about under class 1, primary, secondary, and class 1A. This is, although the BIK is given to the employee and the employee doesn't have to pay any tax on that, the employer has to pay tax on the BIKs, which is class 1A NICs. Okay, if the BIKs are chargeable to tax. Now, some BIKs, as you know, are not chargeable to tax, like use of the company gym. If it's like something open to, just use this general principle, if something open to all employees, okay, then parking space, use of the company gym, all this stuff, like there are certain categories. You can go back to that employment income slide, or more importantly, maybe go back to the Melville section under employment income, Melville chapter, and see what are the kinds of exempt income. Okay, like one mobile phone for both personal and business use, that's not taxable, right? So you might think, okay, there's private use, so that'll be taxable. No, it is specifically exempted, so it's not required. So those kind of things you should remember. Again, that also becomes a potential narrative question, like what are so there'll be a section in the Melville on that, so go and make sure you read that and make a note on that. What are the types of things what are the BIKs which are not which are exempt from tax? Okay, so but there are most of the BIKs we have done are the ones which are chargeable to tax, like housing, luxury housing, expensive accommodation, loan of music system, loan of furniture, like company furnished the house for so much. Remember that language. That means they loaned him the furniture. Okay, then all this stuff, then beneficial loans and all that. So all these are taxable BIKs. So on the taxable BIKs, the employer pays the class 1A NICs. Okay. Right. So this is just this part is 8%. You don't have to remember, because primary class 1, you can just go to the tax tables, and let's go there now. Primary class 1, you can see up to this one. What does this figure remind you of? Does it remind you of something? 12,570. Let's see how much you're retaining, because you need to be ready for your exams. You should have already practiced now. Does this remind you of anything? 12,570. What is 12,570? Does it remind you of something? when your ANI is, let's say, 63K, that means it is ANI 100 less than 100K, your PA is this. That's what I was asking, in case my question was not clear, right? I was trying to see if you remember the PA, right? So you don't have to remember the PA actually, because I think the PA is also given in the tax tables. If we go further up, yeah, so PSA is given. PA is also given. So PA you don't have to remember, but I was just testing to see that by this time you already should have done many problems, and then you would have remembered automatically that the PA is 12,570, right? So I was just trying to help you to see the connection. None of these you have to remember because they're all in the tax tables, but there are certain things which you automatically remember anyway, even if you don't have to, because you've done so many problems using those. Let's go back to the NICS. Right, so we got that. So everything, you don't have to remember all this stuff because it's all in the tax tables. Secondary, again, it's all in the tax tables, okay? There's some additional information here. And there is an employment allowance of 10,500 per annum from the secondary class 1 NICS, which you can deduct, okay? This is also not mentioned here, so probably this is a second of secondary import. But actually, if you get a problem, you'll have to deduct this. So let's just look quickly at. Maybe I can go somewhere here. This is just one of them actually. I don't need. How many do I have? 1, 2, 3, 4, 5. Okay, so I do need this actually. That's what I'm looking for. Anyway. Oh yeah. Okay, never mind. I'll go here and see quickly on tax. What is it? Employment. NICS is here, I think. Yeah, NICS is here, 235. So let me just open one of these here, and let me just open the. Let's just go here. Then we have, what is it? We need to find the tax text, and let me find this one, okay? And let me go to page 235. 235 means 51. Okay, so let me just go quickly and see. So let me go to 258 maybe. Yeah, so okay, now we've already gone to class 2. So let me just go to class 1A, right? So this is, they're talking about, this benefit is secondary class 1. So let me just talk about secondary class 1 here. Secondary class 1 NICS, okay? So here you have to be careful, because this is a 1-year-old book. The rates might be different, so we disregard the rates. We only look at some theoretical information, or the rates we take from the tax table. Yeah, this is the information that is already there. These are some so you see that employment allowance also is this year's employment allowance is higher. It's 10.5. That's why all these numbers, you have to be careful about how to read the book, there is an employment allowance, but you can see last year it was 5,000. So you take the figure, so we need to be careful about this. So we have a 5-minute break now, so we'll come back. So anyway, so we'll continue. Okay, let's resume here. So where were we actually? Yeah, so we were talking about the employment allowance. So you have to make sure you have you keep a track of that. As you can see, the employment allowance is there, and so when you get a problem, you can mention the employment allowance as well. And unfortunately, this is not mentioned in the tax tables. All right. So yeah, so it's not mentioned. So this is something you need to remember, that this year's employment allowance is 10.5K. This is from the secondary class 1 NICS payable by the employer. Okay. So this is what we already discussed while discussing the definition of class 1A. So this is not new information. They have to pay class 1A, and then it's already mentioned the definition. So let's look at an example of class 1A. Example 5 for Melville. So we're talking about NICS, right? So I did open a separate NICS case here. So there's a NIC here. So let's open this and make this full. Example 4. Example 5. Yeah, so this is class 1A NICS. All right, so let's look at the, now you see again how these are different. For last year, it was around 13.8, there was 13.8%. This year, again, you don't have to, that's why for the way you use the book is, you look at the example, you see how the problem is solved, the method of solving the problem, that will not change, but be very careful about the rates, because the rates will change from year to year. As you can see here, it has now become 15%, right? So the UK government wants more tax, so they are increasing the rates of tax on the NIC, the rate of deductions on the NICs. So as you can see, this class 1A or class 1B cannot be used for the employment allowance, which we discussed earlier. That is only for the class 1 secondary NICs, okay, the employment allowance. Now, here you can see, then you have a class 1A contribution. The percentage we will take from the table, okay. Class 1A contribution this year is 15%. So anyway, let's look at the example 5, Deepak. And I think I have done it in your student calc file as well. Let's look at number 5, slide sheet number 5. Topics are given by sheet. Okay. Now this one, I don't know why this is like this, because I think I know why it is. This is because I just want to make this, maybe not this much, this one, okay. Let me just make it left aligned, and then it'll become, okay, yeah. So Melville example 5, okay, we have done it with this year's, let's look at the example number 5, okay, so this is a BIK. So this NIC is not really a part of your syllabus for this semester, this particular class test, okay. As far as if it is, then I'll inform you. But I think I will check it again, but it's not really a part of your syllabus for this, but you might as well learn it properly when you're doing it, because it will be a part of your final exam at least. So let's look at how to do it. Okay, class 1A contributions, calculate the class 1A. So when you get a question like this, you should know what class 1A are. Okay, so class 1A is what is payable by the employer on account of the BIKs enjoyed by the employee. Okay. The taxable BIKs, don't take the non-taxable BIK. They might throw in a googly in between and say that, okay, he was given some parking space, or he was given one mobile phone for free for business and personal use, and that mobile phone had a market value of £600 or something. But the mobile phone will not be charged as a BIK because the mobile phone is an exempt benefit. So that's not it's a tax exempt benefit. So they may actually throw in some tricks like that. So you have to know, that's why you need to know what are the exempt benefits. Right, so let's look at the benefits for car. Okay, this guy has a car of, list price is 37.2, emission is 1.114, all right? And medical insurance of 3.6. and they're also paying for all the fuel. So there's a car BIK. Here you have a car BIK and a fuel BIK, and then you have a medical insurance payment, right? So let's look at the example here. Yeah, so car BIK, what is the car BIK? So if it is 114, then we have to use 114. We have to deduct 75 from 114, or which one? Do we deduct the 75 from the 114? When we want to calculate the percentage for the car, that we want to arrive at this percentage, okay? So do we deduct the 75 from the 114? Right here, if you look at car, yeah, see car, so car is 75, up to 75 is, at 75 it is 21%, and for every extra 5 over 75 it is plus 1. So when the car is 114, should we deduct the 75 from 114 or from what? Is my question clear? This 75 has to be deducted, no, to find out the step, because we need to find out. So this car has 114 emissions, right? 114 is the emissions for this car. So we know that up to 75 is, at 75, up to 75 is 21%, right? But how do I find out this extra 7%? So remember the rule that is there in your, so now you guys are not easily able to recall this rule. So I need to, where is this actually? Where are the, your topic notes? Where did I lose the topic notes? Maybe it's in the tax tables section. Yeah, the topic notes. So let's look at your topic for, what is your topic? BIKs, right? So BIK is topic 3, employment income. So what is the rule I gave you here? You're forgetting all that rule, so we can actually delete all this. Termination pay, it really slows down the call options. Yeah, see, this rule is given here, so you should learn by memorizing the rule and then practicing it multiple times. What is the rule? So as you can see, you have not read this document properly, because this rule is not given like this clearly anywhere else. So that's why I made this note, right? So if the figure is an integer multiple of 5, you use that exact figure, and from there you deduct 75. Okay? And then divide that by 5 to find out the number of percentage points that is to be added to the 21 percentage point base figure for 75 grams emission, or whatever the grams or whatever I've used here. Okay, so this I can't show you the tax tables now because it is being shown elsewhere. Here I can show you maybe the tax tables. Yeah, we can show you the tax tables here. So there's 75, so you need to find out for every extra 5 you need to add 1, okay? So if it's an integer multiple of 5, then you will just divide, you will subtract 75 from that, okay, from the exact figure. If it is not an integer multiple of 5, then round it down. You have to round it down, you can't round it up, okay? You have to round it down to the nearest integer multiple of 5 and then deduct 75 from that number, right? So here the question is 14 an integer multiple of 5? Yes or no? Is 14 an integer multiple of, not 14, 114. Is it an integer multiple of 5? No. You understand what is meant by integer multiple? That means if you divide that by 5, you should get a whole number, no fraction, right? So 114 is not an integer multiple of 5. Is this clear? You understand what I'm saying? Are you familiar with this term, integer multiple? Right, so it's not an integer multiple of 5. So you have to apply my rule. You have to round it down. So that means the number from which you will deduct 75 is 110. So you are getting some topic 3 practice as we are doing this topic 5. Benefit BIK is under topic 3, so you are getting some topic 3 practice right now. So it is, you're remembering this rule, so now you have to deduct from 110. That's what I've done here, right? I have deducted 75 from 110. Yes? Okay. Now, that gives you 75 from 110, I get 35. Now this is my 5. Then I divide the 35 by 5. Right? Because what is the rule? For every additional 5 grams emissions, I have to add 1 percentage point. So I have to find out how much is the excess over 75. And to find that excess, if it's not an integer multiple, then you have to round it down, and from here you have to deduct 75. So take out 35 and then divide the 35 by 5 to find out how many percentage points to add. Are you following? We have already done this before doing BIKs during BIK examination, okay, during the BIK coverage, but we're just refreshing it. That means you're not doing enough practice. If you're not remembering all these things easily, it means you're not doing enough practice. So you must practice aggressively, because the more you practice, in a way this exam is quite easy, although there's a lot of material, but if you can put in a lot of practice, you can score really high marks. So it's not like a previous semester's law exam was more subjective grading. It's a typical humanities art style grading. So you don't get very high marks, although your batch did the best performance so far of all the batches I've taught in law. But here you can do even better, because this is like a maths exam. So technically you can score like 90% easily. Some of the narrative questions maybe you don't get a full mark. But for the calculation questions, you get the number right, you get the full mark, right? It's just that you have to pick up. It's a very slow climb. Everything you do, every calculation you do correctly, 1 mark. Every calculation correctly, 1 mark, 1 mark, 1 mark. Like that, you have to build it up. But you can build up a lot, okay, if you know how to do the calculations. And so there's no confusion about this. The rules are very clear. There is only one right answer in most of the cases. Do you understand? Except for the narrative questions, it's just like a maths paper. So you can actually score very high marks in this paper, but you need to practice. It's just nothing but practice. There's nothing very complicated here. All the rules are very clear. It's not some very hi-fi stochastic calculus or something we're doing. It's very simple arithmetic basically. So it's just a matter of doing enough practice. And I don't think you guys are doing enough practice, because you're not able to answer the simple questions when I'm testing you. Okay, so we get 21 as a base figure. So the answer is not going to match with what is there in the Melville, because this is using last year's rates. You see, the last year the base figure was 20%, not 21%. So I'm using this year's rates to also get you into the habit of how to use the textbook. Okay, see the method of working the problem, but use the rates from the slides and tax tables for this year. Okay, you got that? So 7 plus 21 is 28%. So the car BIK percentage is 28%. So the car BIK therefore is 10,416, because it's 28% into the list price is 37,200. All right. Now, also remember the fuel BIK, that also will not tally with this year's figure, with what is in the textbooks. We have a higher figure, 7896. This guy has a fuel of 7506. Why? Because last year the base figure was 27,800. This year's base figure, if you check for the car emissions, the base figure for the fuel is 28,200. The car fuel benefit base figure for this year is 28,200. Last year they had 27,800, so that's why his number is lower. Okay, and then the medical insurance premium we just add, right? So the BIKs are 10.4, 7.9, and 3.6. So if you add all this, you get this one. So all three added is the 21.9 BIK. This one also we can make left aligned. All BIK combined is 29.9. And so then what is the class 1? Again here our number will differ from him, because you see last year the the rate was 13.8 for Class 1A NICS. This year the rate is, we always take our rates from the tax tables, then we go down to the NICS. Yeah, the NICS, this year's rate for Class 1A is 15%. So I have used this year's rates. Okay, so I can write tax year 25, 26. So we should write this clearly so that we know which tax year we're referring to. So the percentages will make sense. 15%, and so this 3287 is just the total BIK value times the Class 1A NIC percentage from the tax table. So that's 3287. As you can see, it's higher than what you have in the book. The book has 2918 because the percentages and the base numbers are lower from last year. Okay, we got that, example 5. So you got one example, and we managed to revive our BIK discussion. So yeah, we revised. So this one is gone. Okay, so class 4. Now this is for self-employed. Okay, and then you can see this again is given in the tax table. So these are the 3 bands. So you have 3 bands here. First band, second band, third band. Okay. And so the information which is there in the slides, you don't need to memorize this, because so this, if you remember, the income tax liability, along with the income tax liability, you have to pay the class 4 NICS. So let's look at example 7 in Melville in the same chapter. Example 6, example 7, okay? So let's look at the NICS here, okay? So first is trading income for 24-25, 18.58, okay? So if it's 18.58, what happens? Okay, let's look at the rules here. Class 4, okay? We are talking about class 4 NICS. So self-employment, that is trading income, 18.58. So what do we have to do? Let's look at it this way. So we are doing Melville example 7 here, all right? And this year is the same, so we can write this. This year, the interesting thing is that the class 4 NICS contribution has not changed, okay? So the class 4 NICS is still at 6% and 2%, and this year also they are at 6% and 2%. So the government is bleeding the employees more than the self-employed people, because they don't want to discourage business. So by and large, between the two, they will always favor the businesses, because businesses create jobs, right? So anyway, so let's look at it. So trading in 18.58, what do you have to do here? So let's look at the tax tables. If the income is 18.5, 18.6, up to 12.57 is 0%. Okay, so first we find out here under A, okay, so 18.58. So what I want to find out is how much is going to be taxed at 6%, and that is the excess of the trading income over the first upper limit, which is the 0 band upper limit. The 0 band upper limit is 12.57, first band upper limit, that's at 0%. So if I have to find out how much is the amount on which I have to pay 6%, I have to find out the income between 50.2 or 50.3 and 12.6, right? What is that income here? In this case, income is below the 50.2, so we take the actual income, 18.58 minus 12.57, and then this is under the 6% category, right? So then we have to find out what is the 6% NIC on this. That is 6% on this is 361. Do we get the same number as we should get the same number as the book, and 361? Yeah, we got that. Rounded amount is 361, 360.6. All right, let's look at number B. Is this clear? First one is clear. If anything is not clear, you should raise your hand and ask a question. Okay, right, now let's look at the next one. Next question is, Catherine, trading income is 55K, All right, so let's see. Now in this case, so first thing you notice is that 55K is higher than the second upper limit also. So she's actually in the third band. So her income is taxable up to the third band. So we have to do it in two steps. So first we have to find out that, okay, 12,570 is in the zero band. So I've not listed that, okay. So actually, so it's 12.57. So we know that first, okay, up to 12.57 is already taxed. Then we have to see the income that is falling between. So the next step is to calculate the income that falls between the two limits of the upper band. So between this and this. So we have to find out that information. What is that amount? It is, the 50.27, which is the upper limit, minus the second upper limit, and minus the first upper limit. That is the 37.7, which is this, okay? Right? Is this clear? Okay, so this is the one. Now this 37.7 also should remind you of some other number. We don't have to memorize any of them, but it just as a 37.7, what does it remind you of? Here. 37.7, okay? So just to show you, just to see how much you're practicing, so it should remind you of that. Not that you need to remember any of this, it's all in the tax tables. So anyway, this one is 37.7. So on 37.7, she pays 6%. All right, so what is the 6%, Nick? Here I've done this as that 6% into the 37.7. Is this clear? Yeah? Okay, that's good. Okay. So now we have to find out, but her full income has not yet been charged to tax. There's still some more left, which is the 55K minus the upper limit, right? So what is the amount on which you have to pay 2%, Nick? Here. This I've listed it over here. What is the amount of income? How do I get this number? Which is her actual salary minus, or her actual income, not salary. Her actual income minus the second upper limit, which is 50K. So that amount is actually 4730. On that she has to pay 2%. And so the 2%, Nick, is, I just took it from there. The 2%, Nick, is 4730 into 2%. Is this clear? Yeah? Okay. So that's your second one. Let's see whether the answer is correct. Catherine. Okay, no, this is not the whole thing. Yeah. So the whole thing is not this. Actually, the whole thing is here. The full answers are over here. So 360.6 is what we got for A. For B, we need 2356.6, and we do have 2356.6. How is that coming? It's actually coming from, well, strictly speaking, I should have had a number over here as a 0, and I should have added that plus this. Okay, but because it's 0, I didn't add it. But to be, to be rigorous like a computer, you should actually, I should have written this like this. So I should have had a 0 number here. I should have done here, I should have had a number which is 0 into this. To be rigorous, we should have this into 0 over here. And then this number should also be the first term of this. But because it's a 0, I just did a shortcut, but it's actually not the correct method. Even when it's 0, you should add it and show the term. Okay, so you got 2262 plus 95, that gives you 2356.6. Here, that's 2357. That's what you got, okay? And the third one is quite easy. C, I've not done it because the trading income is 12,400. And if you look at the tax tables, the 12 up to 12,570 is 0%. So the payable, Nick, is actually 0 because income is below the first. It's below the first. It's the income falls in the first band, and the tax rate for the first band is 0. All right. So is this clear? Okay. So we have done it. 31 of 32. Okay. Good. So yeah. So just you have to cover this. Practice it yourself. Okay. Because Nick's could come. Nick's could be technically part of your any of your self-employment thing. But anyway, this will be there at least in your final exam. Okay, so let's now move on to certain other important topics that I need to cover with you. So let me just go to, okay, right, okay, now this allowable motor expenses we can cover under 9.7. Lease premium I can cover under 9.7. Okay, let me just go to bonus rules. Now, unfortunately, we were trying to simplify the bonus rules for you, okay? But unfortunately, that's not really possible because we are getting more and more complicated questions on bonuses now. So we need to learn the proper method. Actually, this is the proper way to learn all of tax law. It's just that it takes little more time and it's a little more demanding initially. But the quality of learning that you get by doing it this way is much better. It's a way that you should be trained as accountants, because as you see later on, in accounting, there's no real difference between accounting and law, because constantly, especially if you're doing tax accounting, you will be doing all kinds of, and tax accounting is very intimately connected to tax law. So therefore, it's better to learn like this. Okay, employment income, let me go down to the bonus figures. Yeah, this will be on bonus. Yeah, director's bonuses. Now, I have just referred you to page 92 of the textbook, and we will look at that, all right? Now, we have to give you more elaborate. The simple guidance that we had given you is that in the case of employees so far, we gave you this guidance. In the case of employees who are not directors, is just go by the payment date, and then we tax the bonus on a cash basis whenever it is received. And in the case of directors, we had said that it is based on when the director becomes entitled to receive that money. Okay, but actually, in the case, the rules are a little more complicated. Why have I lost my internet connection? My battery is a little low. All right. So now we can look at the special rule, the strict rule. So we can let's look at the page 92, okay? Let's look at also page 92, but page 92 is actually not adequate. So I'm not going to look at it here. I'm going to look at it here. Okay, let's go to page 92. Page 92 means it's actually 16 here, as you can see. So I have to add 16, so 108. Yeah, this is basically we're talking about. This chapter is income from employment under employment, chapter 7. Under chapter, so these are the ones I was talking about: managed service companies, personal service companies. This is the case of the BBC presenters, which we were talking about. This is also going to be covered under your topic 2, under anti-avoidance measures or tax avoidance schemes. This is one of the subtopics, PSCs, okay? Now, let's go to this one, okay? So this is the thing. Now, here actually this is not adequate because it actually dumbs it down a little bit. It doesn't refer to the section. So we need to understand where the laws are coming from, where all these tax rules are coming from. As I said, this is the best way to study, but it takes a little bit more time. Something is wrong with my internet connection because it seems to be dropping the connection all the time. All right, so let's look at let's look at this Income Tax Earnings and Pensions Act. I've given you the link. You can study this. You're already familiar with studying the UK legislation, because last semester when we were doing duties of directors, if you remember, I had referred you to section 122 and some of the other sections of the UK Companies Act 2006, where the duties of directors are listed there. So here you can see this is a different legislation. What is this? This is the one that governs the taxation of employment income. So all the rules are coming from here. So let's look at now. So as I said, so what is the basic principle of employment income? So I think we can actually maybe go to the full thing and then we'll just go in and out, okay? So it actually comes from section 18 of ITPA. We call it ITPA 2003, ITPA 03. Okay, it comes from so as I said here, the main idea is always on the basis of receipt. So in employment income, if we go to your slides for employment income, self-employed, 1 minute, let me find your employment income slides. These are your week 3 slides, okay? So week 3 slides, as you see here, the basis of assessment, okay? So this information is not incorrect, it is correct, that the basic idea in taxing employment income is that we want to tax the income when it is received. So we don't really care about when it was earned. So we are not using the accrual basis idea. We are using a cash basis idea for income, for employment income. So therefore our first focus is on when it is received, okay? But now the problem here is that, so that's the starting point, that the idea of when it is received, so that takes you to the cash basis kind of idea as opposed to accrual basis. So we don't really care about when it was earned, we care about when it was received. Now, but what happens is that you see this section 18, which is such a long section on all these. It has section 1, section 18, subsection 1, subsection 2, subsection 3, okay, subsection 4, 5. Why do they have such a long section here? Because they want to further refine and make very, very specific, or maybe even sometimes you can think of it as expanding the idea of receipt. So what we understand normally as laymen is that, okay, when did I receive the money? That is, okay, when the money came into my bank account. That's how we would understand received, right? If it doesn't come into my bank account, I say I didn't receive it, right? Like if I pay my landlord something, it doesn't go into the bank account, he says I didn't receive the money, right? So that's how we understand it. But what this section 18 does is that it actually creates a concept of deemed receipt. You know, if you understand what is meant by deemed, I mentioned this word to you before, deemed, D-E-E-M-E-D, deemed. So this is, we can say here is where is our, okay, so I think we have, yeah, it's actually here, right? So this is basically, need to go, yeah, this one, okay? So I can use the language here, okay? So director's bonuses, actually everybody's bonuses, okay? So we can, earnings and bonuses, both, everything, okay? And we can write employees and directors, so everybody's actually. Yeah, so this relates to everyone. And so you see some references in page 92, but this is not adequate. Actually, the legislation is the most important thing. All right, so let me talk about the idea of this is the idea. Let me write it here, okay? The idea is deemed. You need to know this concept, okay? Deemed receipt. What is a deemed receipt? When deemed is a term that we use, which is where we use the term deemed when something is not actually true, but we treat it as if it's true. We assume it's true, okay? So we can say that if, say, Jason is not present in the class today because he has gone to represent the university in some competition, so he has some official leave, but Jason is not present, but because he has gone on some official activity, we will give him attendance. So we will say that Jason is deemed to be present today. He's not actually present, but we are going to assume that he is present. So that is the use of the word deemed, which is a very important word to understand, because this idea is there throughout in the law, everywhere. Tax law, any other area of law, you can easily come up with the idea of deemed, something is deemed to be true. That is basically done by the legislature, as you can see here. This is also done by the legislature. Section 18. Why do they have such a long section on receipt of money earning? Should be quite simple. Either it hits your bank account or it doesn't. But no, the legislature is not happy with that. they want to give a dramatically expanded vision of what is meant by receipt in the context of ITPA, that is employment earnings of either salary or bonus. They want to give you and how do they expand the bonus? How do they expand the concept of receipt? So rule 1 and rule 2 actually applies to employees. So this is where we had given you a simple rule for employees that just focus when the payment is received. But actually there are 2 rules for employees. It's the earlier of the 2. Payment is made or becomes entitled to the payment. All right. And we have already actually mentioned it in the slide here, but we wanted to try because usually what happens for most employees, these 2 dates are generally the same. Okay. For most employees who are non-directors. So what I said here is that rule 1 and 2 is for non-director employees. Now you may find this a little complicated. Why are we reading such a complicated section? But get used to it, because if you practice studying the tax law or any other branch of law like this initially may be a little bit difficult, but when you get to be an accountant, a practicing accountant, you will have to study, you will have to work like this. You will have to look at the law, because every kind of accounting that you're doing will be driven by some accounting standard or some law, and therefore you have to follow that. Especially in tax accounting, you have to follow the tax law. So it's a good practice. It's a more difficult method, but it's actually gives you a much more solid understanding of the concept. So it will make you a better accountant if you study like this. So rule 1 and 2 apply to employees, and that's why the slide mentions this. So we had simplified it to just talk about this, because usually these 2 are the same for employees. But in the case, and so rule 1 and 2, when I say employees, what I mean is someone who's not a director, okay? A non-director employee. So this language is not correct actually. You know why? The way I teach you about how to use the language, because many of the directors are also employees. So I can't say employees and directors. You know what the problem is here? If I say employees and directors, it means that employees and directors are separate categories. That means employees are not directors and directors are not employees. So you have to be careful about how to use the language. You understand? The meaning of language, that's why you cannot say, that's why I always warn you against saying, some people, many of the books you'll find, they write economics books, they'll write Hong Kong and China. Hong Kong and China is not correct, because if you say Hong Kong and China, that means, just like here, employees and directors mean these guys are not this and these guys are not this. If you say Hong Kong and China, that means they're different. That's not true, because Hong Kong is a part of China. So what you have to say is Hong Kong and mainland China. The moment you say Hong Kong and mainland China, that becomes clear that, okay, Hong Kong is obviously not part of mainland China. Hong Kong and Macau is treated as outside mainland China, but included in the overall China. You understand? So if you say mainland China, it's like saying Eastern China or Southern China, which means you're obviously referring only to one part of China. You're qualifying the word China. So that's why I cannot write employees and directors, because that means that directors are not employees. So I have to write non-director employees. Let me just write it like this: non-director employees. This makes it's a bit heavy. It's very wordy, but it's the precise way. So what I'm trying to teach you here is how to use the language. Be very careful, because even many books are not that careful. But this is the way you should learn, because it will help you in the future to be very careful in any business context. When you're using language, you must write very, very carefully. Think about what you are implying. So initially the way I wrote it, non-director employees now makes it clear. This is like writing mainland China and Hong Kong. Now it's very clear. So that allows for the possibility for Hong Kong being a part of the larger China. Okay, now quickly let's go back to this. So why did we say these 2? Because it's coming from rule 1 and 2. I need to go back here. Actually, this should have been on a different page. Let me try to load this so that we can go to this thing here. Let me try to load this somewhere else where we don't need this. This we will. Okay, we can. All right, section 18, receipt of money earnings. So rule 1 and 2, they apply to non-director employees, okay? And so there are more rules applying to directors, but we'll only focus on rule 3 that takes care of the problem for us by and large. Okay, so rule 1 and 2 is basically you find out when they became entitled to the income and when they actually received the income. Then take the earlier of the two. What does it say? So what is the receipt of money earnings for non-director employees? Earliest of the following. So earliest of 1 and 2, applying, now focusing just on non-director employees. I'm just going to call them employees so I don't have to say the whole thing, but here you should know that when I say employees in this context, I'm referring to non-director employees. Payment, find out when the payment is made, find out when the person becomes entitled to payment, okay? Either of the two, take the earlier of the dates, and that's when the money was received. And whenever that money was received, so what will happen here is, if we look at our topic 3, we are doing topic 3, employment income. So there are various calculations here. So let's look at this example here. So let's say this is TY is 24.25. Okay, so TY 24.25. So this stretches from 6th April '24. Actually, we should write 6th April. No. So 6th April 24, we just have 6th April. Okay, the format here is just this, but okay, never mind. So we know what it is, okay? So it's 6th April, we don't need to have such a big thing. Here, okay, 6th April to TY 24-25 is 6th April to 5th April. So this is obviously for 24 and this is for 25, okay? 6th April to 5th April. 6th April to 5th April. This is for 24, 6th April 24, and this is 6th April 25, okay? 2025. So that's your tax year 24-25. Similarly, let's have tax year 25-26, and let's just put it somewhere here so that it's clear. Okay, tax year, maybe we can make this a little wider. So we can make this tax year 25-26, and so this one is 25 and this one is 26. All right, okay. So if you find that it falls within these two dates, it may happen that maybe the bonus is, you have to find out when the bonus is due. What is the bonus due? For which period is the bonus being paid? Okay, that's not really relevant, but the point is we'll find out that, okay, maybe it's a bonus for this period, okay, but the employee basically most of the time the day they get paid and the day they become entitled is about the same. But if there's any language in the question about a non-director employee saying that, but the person became entitled to that payment on an earlier date, right? So if the bonus payment is made on, say, say July 2025, if the payment is made in July 2025, but maybe there is some language in the question which says that for whatever reason, due to some element of the contract or something, that particular employee became entitled to the payment in this period, before 5th April 25. If he became entitled before 5th April 25, then what happens? Rule 2 kicks in. Do you understand? Rule 2 kicks in. Rule 2 is time when the person becomes entitled to payment, okay, or an account of the earnings. So the earnings relate, let's say that it relates to this year, okay, that's of secondary importance, but the point is to find out. So if you get paid here but you became entitled for some reason, okay, maybe they gave you some kind of contract term and they told you you would get certain amount of bonus, so you make a certain amount of money, maybe as a salesman, then you will get 15% commission on that. So if you sell a certain amount of revenue, you generate some revenue, you get 15% commission as written into your contract. So as soon as the revenue is kind of recognized, then you will become entitled to your bonus. So look out for the language of entitlement. So use the language of the statute. Now, Unfortunately, ACCA is not very particular about the use of language. They're not as particular as the way I'm teaching you how to write, okay? Be careful about how, that's why I rewrote my non-director employees. Unfortunately, in the exam, they are not. So you need to have some idea about the exam pattern of questions. So some of these things I'll teach you today. No, anyway, so, but it's best if you can become entitled, if you remember the statute, and then remember it this way, and then you can say became entitled, section 18. We have a 5-minute break. Okay, let's go back here. Okay, so I just want to map this. So it's better, as I said, ACCA is not that particular about the use of language. You'll see some other examples. But if you know the law clearly, on tax, okay, and so then you can, if you write this, if you think that there is some information in the question which says that the employee became entitled, so the best thing to do is to say that employee became entitled on this date. Rule 2 of section 18 applies. So section 18, subsection 1, rule 2 applies. And if you can remember that, that's very good. Okay. Otherwise, just say became entitled. Remember the language of the section. And so if you use the language of the statute, then we can defend giving you the mark. Okay. Even if ACCA has not asked the question properly. If you can use the language of the statute, that's a foolproof method, right? So payment is made or person becomes entitled. Rule 1 and 2 applies to non-director employees. Rule 3. Now, I'm also showing you the mapping of this to the Melville textbook. So Melville has dumbed it down a little bit. He has not referred to the section and not given you the section. So the better way to study is actually from the sections, because you get the full precision and nothing is above the statute. Everybody has to follow the statute. So this A and B is actually referring to rule 1 and 2. So right now, all through we are studying only 18 subsection 1, okay? We're not going into the other subsections. You see, the rule 3 applies to the employee any time in which the mention falls, okay? So if rule 3 applies for directors, okay? So rule 3 is here. If he became a director at any time, and the meaning of director is again further applies. So basically, independent directors also get caught in this. So we don't worry about all that. We just worry about subsection 1, rules 1, 2, and 3. Okay, so 1 and 2 are mapped to this on the Melville text. And for a company director, you have rule 3. Rule 3 has 3 parts, A, B, and C. And so that is reflected here. Okay, but this is a dumbed down version. I would just recommend that you just follow the statute. Okay, so 1 and 2 is clear. Rule 3. What happens if you're a director? If you're a director, and if the employee is a director, right? And so basically the director definition. So most of the directors will be also employees, managing, especially the managing director, etc. And the earnings are from the employment with the company. Now here for directors, we have to look at 3 things. We have to look at 3 particular events. When they happened, and then we have to take the earliest. So it's always the earliest. So when it comes to receipt, as you can see, section 18 deals with receipt of money earnings. It seeks to expand the definition of receipt. And how is it expanding it? It is giving you different types of events. It's defining different types of events. And then it's asking you to take the earliest of the events. So it's always earliest. So that part is common. Earliest of the following, 1, 2, and 3. Okay. Again, with this, whichever is the earliest of one, A, B, and C. Let's look at A. Time when a sum on account are credited to the company's accounts or records, whether there's any restriction on the right to withdraw, whether or not there's any restriction on the right to withdraw. Okay. Why are they writing it like this? This is actually an anti-avoidance measure. So when you discuss anti-avoidance tools, you can even discuss this section 18 subsection 1 rule 3 of the ITPA 03. This can also be part of your answer on topic 2 on tax and ethics. Okay, one of the avoidance. It's not so important, but you can, if you have extra time, you can write this. That is because it's an anti-avoidance measure. Because what can a directors are very powerful. They can decide, okay, so what they can decide to do, because remember everything is based on receipt, okay? So maybe the director is becoming entitled and basically is going to have this condition satisfied, but the director does not want to be paid until this tax year. So he says, okay, these are the earnings for this year. They already know the earnings. They know what bonus they're going to get, but they don't want the bonus to be paid out until this year. Maybe they have some information that the tax rates will be cut next year, or they maybe have too much income this year. They want to show some, they want to smooth out their income, reduce their tax liability. So the tax department doesn't want the directors to do that. So therefore, for directors, what they're saying is, see, if the income is already kind of recognized by the company, etc. So what the company will do is, the company might give a credit, company might pass an entry saying, credit liability to directors on account of bonus payment for director. Okay, that's a liability for the company to pay to the director, and debit the bonus expense, right? So they debit the bonus expense, credit that. So this is what they're talking about. If there is such a credit, but the money is not paid, the money is kept in some kind of a suspense account, etc., where the money is not paid, it's not withdrawable by the director, but still the company's already made a provision for it, okay, by saying, okay, so they're credited for it, credited the account and already debited the bonus expense, but the director is given, director says, okay, don't let me withdraw the sum, so then I can say I didn't receive it. So to avoid this, the tax department has written this section like this. Even if you didn't get the money, if there was a credit in the company's accounts, okay, basically the sum of money that was due to you, if it's credited in the company's accounts, even if you are not allowed to withdraw it, we will look at that time, and if that is earlier, we will take the earliest off, okay? So that's one event, okay? The second event is, if the amount, so B and C are actually quite similar, but they have written it in a slightly more complicated way. This will still have an impact. They are not the same. B and C are not substitute, they are slightly different. But here the key word we need to focus on, and here we will take you to your notes here. I'll take you to your notes here, so we don't need to worry about that. Okay. So special rule for directors. So this is actually section 18. Okay. So I've just copied the text of section 18 here. So we are also looking at the text of section 18 here. So 1 and 2 we already did. Rule 3. Okay. So what I have done is, for your benefit, in your notes file, okay, your online notes file, I have created this section actually where we talk about this. Somehow it's frozen. Okay. So I've created this section which I now call this bonuses and earnings. This is mainly relevant for bonuses because the question in the exam comes like that, right? So what I have done is I've highlighted the key words. So when you read the statute, we watch out for some keyword. So rule 1, the key word is actually, key phrase is payment is made. This is a normal understanding of money. If I pay you some money, you get the money in your bank account, so payment is made. That's very simple. Rule 2 is becoming entitled to the payment, which is slightly more broader than, you may not get the money yet, you haven't got the money yet, but you became entitled to it because of some contractual terms, or somebody decided in the AGM, it was decided that Sylvia will get a bonus. Okay, she has done very well this year, so she will get a bonus of whatever, £10,000, but the bonus is actually not paid until the next tax year, but still she will be taxed in the previous tax year because of an AGM they took a decision to pay her this money, so the amount already became clear and she became entitled to receive the money. Okay, so therefore we will say that she got the money in the previous tax year, like here. So even though the AGM is held this year and in this tax year, they already decide that they have to pay her this 20,000 bonus or 10,000 bonus, but she doesn't get the bonus until next year. But she will still be taxed in this year by Rule 2. So that's why I said by Rule 2. So this is for non-director employees. Now Rule 3, I have highlighted the parts which you need to focus on. The key parts of the key words or phrases in the statute, underlined here. Okay. This should be in bold. I've made this also in bold, so I should make this also in bold. payment is made, or rule 2 is becomes entitled to the payment, which is what you see also in your slide. Okay, this is what is being reflected in the last part of this slide. Now, coming back to rule 3. So as I said, in rule 3A, earnings are credited in the company's account. These are the key phrases here. For rule 3A, we look at 3 events. We look at the timing of 3 events. When did this happen? Okay, when did we first sight the moon on this date, etc. So when did this happen? When did this happen? When were the earnings credited in the company's accounts, even though the director could not withdraw it? That's the first event. So watch out for this phrase. Second, B and C have the same keyword, determined. Okay, what is the meaning of determined? I've given you a definition of determined. Yeah, determined is, the meaning of determined in the law is that the sum becomes certain. The quantum of money becomes certain and definite. Okay, so if you remember here, for instance, when we look at the treatment of bad debts in self-employment trading income, what is the meaning of certainty? The sum becomes clear and certain and definitely known, right? So what do? The general principle in the tax law is that when we say, for instance, just look at this, where have I written the general principle? Anyway, so so this is the general principle, that only those amounts which are sufficiently specific and certain. Okay, if it's a vague amount, then it's not clear. So if it's sufficiently specific and certain, only those can be brought into charge as income, that is, you can tax it. Okay, until it's specific, you can't tax it. And then you also can't allow it as a deduction. If it's not specific and certain, then you can't allow it as a deduction. So this is the general principle, right? Only amounts that are sufficiently specific, which you can remember as a general principle, that will help you to remember 2 things. One, this idea of determined in rule 3, B and C. Because it says if the amount of earnings is determined by the end of the period, then we look at a particular date. Okay? If the amount of earnings is determined by the end of the period, we look at a particular date. If the amount of earnings for a period is not determined until after the period is ended, then the time when the amount is determined. Okay? So what B and C is talking about is the importance of knowing the period for which that bonus applies. Okay? The period for which, the period in which the bonus is earned or accrued. Okay, so what might happen is that, what this rule B and C actually says is that, okay, if you are a director, now let's talk about directors. If you are a director, there is some bonus that you have basically earned because it is accrued in this tax year, because it relates to your activity for this year. Whatever you did, good work you did, you earned a bonus because it accrued in your name. Okay, but maybe let's say that, let's take the first case of rule 3. Let's take the first case of rule 3B. If the amount of the earnings for a period is determined by the end of the period, then the event we note is the time when the period ends, right? Determined by means is but before the end of the period. Okay, so the end of this period, the bonus you earned it relates to this year, is your activity for this year. So let's say it's determined before 5th of April 25. If it's determined by 5th of April 25, then for under rule 3B, we will take the date of 5th April 25. So remember, we are comparing various things. We are comparing when the amounts were credited into your account. We will find out when it was done, and we will note the date. Okay, maybe that date is let's say, just example of 3B. Maybe that date was, let's say, 31st December. Okay, maybe it's 31st December under. Why is it not coming out? Yeah, maybe it's 31st December under rule 3. Rule 3A. Okay, under rule 3A, we find out the date when it was credited into the account. And that date is actually 31st December of this year. Okay. Then we find out the amount of earnings is determined when the period ends. So we find out that the bonus was determined. Determined means became certain. So when does it become certain? So as I told you here, the meaning of determined is, I'm sorry, I'm jumping around various concepts right now because I wanted to explain determined first and then I moved around to thing. Let me explain determined once again so that it's clear. Determined simply means that the amount becomes definite and certain amount. Why is this important? Because we have a general principle in the law that only amounts that are specific, it's an important thing, so I should actually highlight this, okay? This is a general principle that we are applying, and then we are applying it here, and that's why in Rule 3, B and C, you use the word determined. Why are you using the word determined in Rule 3, B and C? Determined, you see, determined is not determined, and then when it is determined, okay? Why is the word determined used? Because determined means that something becomes a definite and certain amount. And why is that important? Because we have a general principle in the law that only amounts that are sufficiently clear and certain can be taxed. And therefore, only amounts that are sufficiently certain and definite can be taken as a deduction. And that's why, if you remember a related concept now here, now quickly let's jump to self-employment or trading income. You'll find one of the rules in trading income is under bad debts. General provision for bad debts is not allowed because general provision means it's not really clear. You're just making a vague general provision. But if it's a specific provision for some particular bad debt, then we can take that, we can allow that because it's a certain number. Okay, you sold some amounts to Edmund. Maybe you find that whatever has happened, something is wrong with Edmund's business. Maybe he can't pay you back. So you have that information. So whatever the amount you sold to Edmund, you say, okay, bad debts on account of sale to Edmund, provision for that bad debt, that's allowed. Okay, because it's specific. Is this clear? Are you following this? Always try to learn in terms of general principles because that makes everything easier to remember. And you also become logical. All right. Now, so here we only focus on determined in Rule 3B and C, because so here we only look at, did it become a definite and certain sum? Although the company's liability to pay, it's not the same as this because that may require some additional considerations, okay? But basically it's just whether it became a definite sum, and this typically will happen when the board resolution fixes the exact sum or when the accounts recognize a definite liability for that specific amount. So they will refer to a board resolution or whatever. So basically whatever you feel that if the amount became certain. So what happens is that if you get a question on director's bonuses, you find out from the question information whether at what time did the amount become certain and definite amount of money. And then you say, okay, by Rule B and C, it became determined on this date, and so. And so here we can now apply number C. So if you see that if it became determined on Rule, let's say it became determined in this case, Rule 3A, what is Rule 3A? No, actually it's not Rule 3A, this is actually Rule 3B. So we can say this is Rule 3B, and let's say it was credited into the accounts on, let's say like this one. Rule 3A, the sum account of the earnings is, sums on account of earnings are credited in the company's accounts. So let's say this was happening on, let's say it happened on, say, maybe what, 15 December in this year, okay? 15 December in this year. And this is basically by Rule 3, not Rule 3A, but Rule 3, yeah, this is Rule 3A. This is actually Rule 3B, okay? By Rule 3B, we find that it was determined before the end of the period, okay, whatever date. And so by Rule 3B, the time that we come out with is when the period ends. So if it's determined on 31st December, this will actually become, by Rule 3B, the date becomes the end of the period, which is actually here. If it was determined on 31st December, I can copy this here and write it here. And this will become actually 5th April. 5th April here, okay? So 5th April over here, okay? In 5th April 25 becomes the date by Rule 3B. And by Rule 3C, if the amount is not determined until the period has ended, that is, the amount is not determined by this date, then whatever is the date when the amount is determined. So what is, let's say that by Rule 3C, okay, we'll just take one and then make this Rule 3C. Rule 3C, then maybe the amount is determined somewhere here, maybe on 15th of July, okay, 15th July, let's say, 15th July, there 15th July here, okay, it's actually 15th July in this year, okay, by 15th July in this year, so the Rule 3C date will become, in this case the date will become the same as this, 15 December, the second, sorry, this is not the date, this is the date here, this is the relevant date, these are the 3 dates we come out with. And then same thing is that in the case of the bonus for this year, bonus earned and accrued in this year but not determined until 15th July of next year. So we take the earliest of the 3, alright? So what is the earliest of the 3? It becomes by Rule 3A, it becomes 15th of December, okay? Which is the date on which, according to Rule 3A, on 15th of December, you credited the sums in the company's accounts. Are you following? It's a little bit complicated, but it's a good training. It's good training for you to learn the law like this, to learn the tax law like this, because if you can do it this way, you can do anything. It's the most complicated way, but it's also the most solid way to learn it, all right? So it's just, all that is happening is the tax department is expanding the definition of receipt by defining all these specific events, and then it's telling you to look at, so you just have to remember these 3 rules, okay, and the sub rules of Rule 3, and then essentially you just look for either the amounts are credited or when the amount was determined, okay, because if the amount is determined, you need to know both B and C, because if the amount is determined before the end of the year, right? So in this case, in Rule 3B, if the amount is determined, let's say on 31st December, which is before the end of this tax year, so in that case, it will be the last date of the year, which is 5th of April. And that's why Rule 3A applies finally here, because 15th December is the earliest of these 3 dates. This is clear. Okay, you have some idea. Maybe it's not clear on the first reading because it's very complicated, but if you can play it back and listen to it again and understand the rule, try to read the section and remember it this way. So for directors' bonuses, just watch out for Rule 3. Just follow that. This is the safest method, because if you can remember this and you write this in your logic for the answer, okay, even if ACCA's wording is not correct, we can support giving you marks because the answer is based on the statute and nothing is above the statute, right? Is this clear? So I have to move on from here because I need to cover a lot of things. Everything is on full, yeah, we have about a few minutes. Okay, so let me quickly now cover. So I've covered the bonus payment part. This is the one that I wanted to cover. Where is the other part here that I wanted to, let me see here. Where are my, this is the one maybe, yeah. So let me just check what else I wanted to cover. Allowable motor expenses. I'll come to bonus rules I've done. Now we'll do lease 9.7. Okay, so we should be able to hopefully cover it. Maybe I'll just overshoot by a little bit. Okay, let's go to now topic number 4. Self-employment income. Maybe we don't need this, but we'll still. Okay, so let's look at this one, and let's quickly look at. Let's quickly look at. We don't need the tax tables. Okay, so let's look at self-employment income, and let's look at question 9.7. So I've already shared the material with you. So this question is important because, see, in 9.6, there's no answer to this question in the textbook. So I got the answer from the MC and I've shared this with you. So this 9.7 is important because it teaches you how to do the self-employment tax-adjusted trading profit calculation for the GAAP or accruals basis, right? Because in this case, we have to know both the methods. We have to know cash basis, which is given in 9.6, where you have the answer already in the textbook, and that's much simpler. And so accruals basis is much more complicated. You need to remember a lot of rules. So for that, you should remember, refer to the textbook and see what is deductible, what is not deductible. Go to section 9, and that's where we'll go to short lease premiums. Okay, this is falling under the point of what is deductible. Okay, so here we have to remember one thing. Unfortunately, I need to look at I need to look at the slides. Yeah, so Imran is here, and the slides, you have to remember one thing. Slide 4, self-employed. Okay, so self-employed, now income, computation of income. The slide we need to remember is this one, okay? Yeah, this is the one we need to remember, okay? Slide 12, okay, is what we need to remember, but we'll keep coming back to it. But let's look at question number 9.7. So slide 12, if I could open this somewhere else, that would really help us, because I don't need this anymore. So maybe I can open slide 12 here, and maybe I can open slide 12 here and go to slide 2. This is what, slide number 4, okay? So let me open slide 12 here, and that will help us to refer to it without having to, then I can maximize this page. Then I can go to 9.7 Imran here, and then have the lease premiums here as well. Another thing I need is actually this one. I don't need this, so let me open another thing I need is actually, I need lecture 1 introduction. Again, I need to find out the property income. Where is our property income here? So I think property income is somewhere in 64 or something like that. So if I go to 67, weekly rates is property income. Let's go to short lease premium. Lease premiums, okay? So let's go to this one. Short lease premium. Okay, so this is going to topic 1. Okay, topic 1 of slide 73 and 74 of topic 1. Okay, we got. You don't need that actually. I can't stay here. Maybe. Okay, so let's go to 9.7 Imran. All right. So let's look at some of these things, and some important points I want to highlight here is the motor expenses, okay, allowable motor expenses. Now you'll see that. So first, let me just give you a heads up on this, okay. You'll see this is all is this is where the question will be in this format on self-employment income. Most likely you'll get a gap question because it's more difficult, so they'll ask you the more difficult question. But you have to know cash basis also, because you may get questions on cash basis also, so you can't leave out anything. So okay, so one of the things you'll find here is that motor expenses will be given, okay? Motor expenses will be given, and then there'll be a statement. Now this is why I say that ACCA is not particular. I would just call this sloppy writing. They should not be writing like this. It's unfair to the students. But this is what the questions are like. They will just write that it's been agreed that 1/10 of motor expenses are for private use. So what is the rule you're following? You will see, you'll start with the net profit. This is accounting profit in the account, which in the case of Imran is, this is the net profit or loss you start with here for Imran, okay? You start with that. This is here, okay? And then you do some adjustments. Add back what is shown but not deductible for tax purposes. So private expenses not deductible because you're trying to calculate the trading income. So you want to find out how much of the income is actually due to the pure trading activity. You want to strip out everything else. Private use is not part of the trading activity, it's not allowed. So you have to add it back. So one of the things when you do, what are you going to do here? So you know that you are going to add back anything for private use, you're going to add back. So what does the language here say? 1/10 of motor expenses relates to private use. So what is the natural tendency for anyone to do is to just take the total of motor expenses and add back 10%, 1/10. Okay, 1 by 10 of this one you will add back. Okay, but that would be wrong under ACCA, because when they write this, what they actually mean is only the allowable motor expenses. That's what I mean by allowable motor expenses. That's what they mean when they write. You see how imprecise it is. Okay, it is. So instead of saying allowable motor, they just write motor expenses. So you have to read it. If you get anything like this, if the question does not say allowable motor expenses, if it just says this, you should just still read it as allowable motor expenses and make a note saying that only allowable motor expenses considered, and then take 1/10 of that. What is not allowable here? Servicing, okay. Fuel and oil, okay. Loss on disposal of motor vehicle, not okay, because it's a capital item. Do you understand? Accrual basis, no capital income expenditure allowed. Later on you will get capital allowances. So capital item, not allowed. So loss on disposal of motor vehicle, not allowed. 422 out. Road fund, license and insurance, okay. Fine for speeding, not allowed. Fines are not allowed. Remember, I showed you in the Melville, fines are not allowed. Okay, so fines are not. So what is not allowed? 422, 700 not allowed. So what is the actual motor expense? 1165, 2815 and 610. So remember these numbers. When I look at the, where is my answer to Melville? Okay, let me just go here and take the answer again once again, and let me just go to this here and tax examples Melville answer 9.7. All right. Okay, we can make this full here. All right, let's look at this and see. We start with the net profit, then we add back. What are we adding back? Private motor expense. Yeah, there you see, private motor expenses added back 1/10 of 1165, 2815 and 610. You see that? 1165, 2815 and 610. So when you see the answer, you may not understand why these two are not allowed, not included, 422 and 700, because this actually what they mean is allowable motor expenses only. So you have to take only that. Is this clear? Okay. So allowable motor expenses, the first point I wanted to mention. Then we have to discuss lease premium amortization, okay, which is all right. So we have to discuss many other things actually. So I just want to highlight some of the key things. Okay, why are we adding back? Okay, now I won't be able to refer to it all the time, but you look at it. Okay, I'm just going to explain all the parts of the question. Why are we adding back wages for Imran's son? You will see in the question it says this guy was not doing any work for the business. He was just getting 1,000 for nothing. Okay, he was not doing any work. So add back. Personal income tax, you'll see some information in the question. I'm not referring to the question, but you can confirm it later by looking at the question, because that will make me lose time. This is added back because personal items are not allowed. Okay, so there is some deduction for his personal income tax and NICs. That's not allowed. These are the class 4 NICs, because this guy is self-employed. So remember, private medical insurance, not allowed. Okay, what is the language here? Let's look at language here. Under the notes, you'll see wages includes, this guy was not working. He doesn't work for the business. Wife is allowed. Okay, now another thing you have to remember here is everything that is mentioned, you have to, the answer here is not adequate. This guy has only mentioned the things which are not allowed. He's added back only the things which are not allowed. But you have to make a comment about everything. So you have to write wife's wages. You don't have to write Imran's wife and all that. Just write wife's wages. So we know wife's wages, you just write okay or put a dash or 0. Wife's wages 0, or put a tick mark, which means you know that wife's wages are allowed. So we are not adding back. This is clear. But you cannot write the answer like this by only including things where something has to be added back. You have to also include the things which don't have to be added back. So when you're answering your Bob is this kind of question, I think. Your Bob is this kind of question number 30. When you're answering this, you have time till Sunday. Make sure your answer includes everything. Wages to son, not allowed, add back. Okay. So under add back, you just put a thing not allowed, you don't have to write. If you add back this, then we know it's not allowed. But here you have to write additionally, wife's wages, tick mark, wife's wages, okay, something like that. Wife wages 0. Just put wife's wages 0 is the easiest, okay, to remember. Wife's wages 0. So everything that is allowed has to be put as 0, okay? That must be clear. All right. Personal income tax, not allowed, add back. Private medical insurance, not allowed, add back, okay? 1/6 of telephone, private use, private not allowed, add back. 1/6 of telephone of 1650. So telephone, this is quite clear. Okay, there is no disallowed telephone expense. So repairs. Repairs are being added back of 750. Now this repairs is not what we normally understand by repairs. Okay, this is a special type of repair because this number of 750, it's talking about, this is one case where I would say it's the word repairs is not being used correctly. Again, this is another case of improper use of language, but most people are not that particular. Even in the textbook, they are not that particular. So this is a type of repair, okay, actually it should be called work, okay. Work which includes a 750, the essential work should be called essential work, but they'll call it repairs. So I'm teaching you on 2 levels. You need to understand what it logically should have been called. Should have been called work, not repairs. We shouldn't have used the word repairs, but they will use the word repairs. You have to watch out for this part. Could not be used. Whatever the asset is, the asset could not be used until the repairs were carried out. Well, what does that mean? If you buy a machine which can't be used can't work in the factory until you carry out some additional work on the machine, that means what? That machine as it stands, it does not have the functionality that you need. Okay, so you are doing some additional work on it to improve the functionality or enhance the functionality and therefore make it suitable for you. So that means straight away it has the idea of capital expenditure. Because what is capital expenditure? Is the basically expenditure on machines, other things which improve your productivity. Now if you're having to do some additional work on something, like you remember there's a case of a ship where, if you go back to Melville, we can go back quickly and see. There's a case of a ship, Law Shipping Company versus CIR. Allowable expenditure, what is not allowed. Somewhere you'll find political donations, entertainment and gift. Here, you see. Law Shipping Company, what happened? They bought a new ship, but the ship was not seaworthy. So what's the point of a ship if it can't sail on the seas, right? So you had to do some additional work on that ship. They called it repairs and they tried to take a deduction, but it was not allowed because they said without these additional works on the ship, you could not make it sail. So what's the point of a ship which can't sail? So that means that you had to improve the functionality of the ship. So those expenditures on that work are capital expenditure, therefore not allowed under accruals basis. Is this clear? Law Shipping Company versus CIR, okay, is the name of the case. But basically, this repair, why is it being added back 750? Because this 750, so when you're reading the notes, watch out for this kind of language. Could not, some work you did, repairs they're going to call it, work you did on this some asset, could not be used until the repairs had been carried out. Straight away is giving you a clue, is that this means that it's a capital expenditure. That's what you're doing, otherwise you couldn't make use of the asset. So that's going to be added back. Okay, quickly. Let me see quickly here what I can cover. We have, okay, I might overshoot a little bit. So if you need to go to a doctor or something like that, you have some urgent appointment, you can just leave and ask somebody to mark your attendance. Okay, so therefore, yeah, so let me quickly go through loss or repairs. Now you know why it's added back. Loss on disposal of motor vehicle is capital expenditure, not allowed. Speeding fine, fines not allowed. Motor expenses, I already covered this. Business entertaining, we know is not allowed. Entertaining, political donations not allowed. Increase in general allowance for doubtful debts. What did we teach you here? Somewhere here, maybe, I don't know where it is. Yeah, you see, the general rule is only amounts that are sufficiently specific and certain can be brought into charge. That's why they are talking about determined in section 18.1, rule 3, B and C. Why are they using the word determined? Determined means the amount became definite and certain amount. Why is that important? Because we have this general idea. So in self-employment income also, specific provision and identified doubtful debt is allowable, but general provisions are not allowable. So you watch out for that language. General provision for doubtful debt is not allowed. Okay. Lease premium amortization, now I'll come to that, and depreciation obviously not allowed. Okay. Trading income not shown in the account. This also I need to show you. So two things important I need to show you. So I will definitely overshoot. So let me first do the lease premium amortization. Okay. Now whatever you see is lease premium amortization, look at the question here. Question 9.7. What happens in the question? Yeah. So he's operating from rented premises, and to take the premise on rent, he's got a 10-year lease, and he's going to take he's got a 10-year lease, and he pays a lease premium of 7,000. All right. So 10-year lease, 7,000. What is a lease premium? If you remember, we were trying to look at week 1. Okay. Where did I find that? I actually have that week 1 somewhere down. Week 1 lecture, lease premiums. Okay. So lease premium is what, when the real estate is very scarce, you can't get an office space, it's a hot market, and so you pay extra money to the landlord for the privilege of receiving the lease. The landlord is so kind, he's giving you the lease, is allowing you to lease his property. For that you are so grateful that you pay him an extra premium. That's a lease premium. How is the lease premium being taxed in the hand of the landlord? So remember, when a lease premium is paid, there are two parties. There's a landlord and a tenant. So how is it being taxed in the hand of the landlord? Go back to slide number 73 of topic 1. Okay. Long lease, and this is a short lease premium. So you'll see that the topic in Melville will come down a little bit now. What are the repairs which were not allowed? What are, all this is not allowed. Entertainment and gifts not allowed. Political, definite. Bad debts. What is allowed? Allowable expenditure. Allowable expenditure, short lease premium. If you read all this, you'll find answers to all kinds of questions. So short lease premiums, this is allowed. Okay. What does the rule say here? A premium paid for the grant of a short lease. Short lease is less than 50 years or less. Discounted according to the length of the lease. Now, what is this part referring to? Discounted according to the length of the lease. This is referring you back to slide 73 and 74 of topic 1. See how the main idea is that we want to have symmetry. So we are going to charge the landlord some amount of, we're going to tax some of the income from the lease premium in the hands of the landlord. And so whatever the amount we are taxing for the landlord, that's going to be the exact same amount that we will allow as a deduction for the tenant. You understand the logic, right? Whatever is being taxed in the hand of the landlord, whatever that amount is, that same amount will be allowed as a deduction for the tenant. So let's see how let's recap. We've already covered it. Let's recap how it was done for the landlord. What is the rule? The taxable amount of the short lease premium is amount of the premium minus 2% of the premium, okay, for every year of the lease except the first. So n minus 1. So in this case, let's look at the example, okay. 36K premium, 25-year lease. How much is taxable? 36K premium, 25-year lease is start with 36K minus 2% of 36,000 times 25 minus 1, which is 24. Okay, it's just the application of a formula. They came up with this rule, so we don't need to worry about why the rule exists. We just need to know the rule. Okay, taxation of short lease premiums. It can be important in both taxation of property income and also self-employment income when you're adding back and giving a deduction for the short lease premium in the calculation of TATP. Are you following so far? Yeah? We go back to topic 1, rule slide 73, rule for short lease premium, and the idea is a mirror image. Whatever we tax in the hand of the landlord, that is the only amount we'll give as a deduction to the tenant. Because the tenant is paying the amount and the landlord is receiving the amount. So when he's paying, we should give him the money because it's a business expense. It's for his rented office. So So this is discounted according to the length of the lease. This is referring to your method of calculation of the taxable amount of the short lease premium. A chargeable amount to income tax, amount of premium minus 2% of the premium into n minus 1, where n is the tenor of the lease. Then you get up this number, 18,720. Okay. So what are we going to do here in the question on the number 7? Now this guy, if you see, he has taken a deduction here. He paid 7,000 on a 10-year lease, and though he just divided 7,000 by 10, and he took a deduction here. See, less, he's calculating his profit. He took a 700 deduction on the lease premium amortization. But we can't allow this because there's a specific rule for this. So whatever he did arbitrarily, that we have to add back. That's why lease premium amortization is added back in step 1. Okay, but that's not the end of the story, because now when you go to, okay, so I'm not just going to overshoot a little bit, okay, maybe about max 10 minutes. So now, when lease premium amortization, first step we have to do is we have to add back the amount that he has arbitrarily taken as a deduction, just divided the premium by 10. No, that's not how it works. So we have to add that back first. Then we'll give him a deduction. Where are we going to give him a deduction? Look at this slide. What is the format? First you start with net profit in the accounts. Add back all the expenditure that is not deductible. Son's salary, fine, political donation, all this general provision for doubtful debts, add back everything. Then add back trading income not shown in the accounts. We don't have any such thing in the case of Imran, but if there is, you have to add back. Less expenditure deductible for tax purposes but not shown in the accounts, right? So he has not shown the right amount in the accounts. The lease premium, the short lease premium, is actually deductible. Look at this. Under allowable expenditure, okay, self-employment income, one of them is, so you have professional fees, legal fees and all that. Then one of them is short lease premium. So discount according to the length of the lease. So whatever is the amount taxed in the hand of the landlord, that's being given by this part. Discounting according to the length of the lease, that's the taxable amount. Melville has not made it very clear, so I'm making it clear for you. So this part is referring you to the amount charged taxable in the hands of the landlord. So exactly that amount he will get as a deduction. And how will he take it? He will take it in equal annual installments over the lease term. So first find out whatever that amount is. Like if this one was, if in the case of Imran it was a 25-year lease and 36,000 premium, then the amount taxable in the hand of the landlord is 18.7, and then amount deductible for Imran would be, if it's 25, so it would be 18.7 divided by 25. Okay, that would be the amount. So that's the basic method we are applying. So what we do is, what is the amount? You see what is the amount shown? The lease premium amortized. Then we add back, we deduct. So you see what is deductible here? What is showing you the rules? Okay. What is the format we are following? Deduct the expenditure deductible for tax purposes but not shown in the accounts. Short lease premium is deductible according to this method. Okay. Remember, this is not allowed under cash basis but accrual basis. Okay. So if we have this, we deduct this one, the expenditure. How? What is the answer showing you? Less the less allowable expenditure not shown. Lease premium. 1/10 of 82% of 7,000. How is he getting 82%? 82% because if I show you here, we can just do it quickly somewhere. Maybe where is my calc file? I have here. Let me just open the calc file quickly. If we just open the calc file quickly. Okay, let me just open the calc. Let's do it in your calc file. That will become easier. So I'm taking a little bit more time. Okay, so this is which one? This is topic number 4. Topic number 4. Okay, so under question 9.7. Okay, so let's say question 9.7. Question 9.7. All right, so let's just do the short lease premium. Okay, short lease premium. Okay, what is the amount? So what is the amount of the bonus? What is the amount of the premium? 7,000. What is the tenor of the lease? It's 10 years, right? And this we have a 2% figure, right? We have a 2% figure that is there as part of the formula, all right? So that's 2%. Let's make it 2%. Yeah, 2%. We got that, right? 2% is what we need, the amount of the premium, 2%. So what is taxable in the hands of the landlord is 7,000 minus, what is the amount that we will minus? It is 2% times the 7,000 times 10 minus 1. Are you following? Yeah? That we are just applying the formula from here, right? We're just applying the formula from here. Okay, so yeah, so this is what we are going to deduct. Let's just make sure we are applying the right formula. Yeah, so it is 2% into the amount of the premium times n minus 1. And that's what we have done. 2% times the amount of the premium times n minus 1. Okay, so that gives you this amount. So then if you get the actual amount taxable in the hand of the landlord is this 5740. This is clear? Because this is the amount taxable in the hands of the landlord. So this is the deduction that he will get. Now we did, how much is the actual deduction he's allowed to take? It is this divided by the tenor of the lease this time. Now we are applying this part of Melville. Where did the Melville go now? Why can't I see my Melville? Okay. This is okay. Maybe I have to open. Where did the Melville go? Okay, let's just go to the Melville. 574 is what we are looking at. We are now applying, after finding out the discounted according to the length of the lease, which gives us the 5740 number, and then we are deductible in equal annual installments over the lease term, which is 10 years. Is this clear now? All right, okay, that's why you have, let's look at the answer. Allowable expenditure not shown in the account. Remember we added back first. Whatever he took as a deduction, we added back. It doesn't matter, even if he took 800, 900 by some mistake, you add back whatever he took in the accounts. Add that back. Now give him the proper deduction, 574, which is 1/10 of this, which is we also got 574 in our, now I've lost the calc file, but it's okay. You got the calc file, right? So you understand that. So now you know how to do the amortization of short lease premium, all right? I have one more thing left, which is to show you, which is this one. Everything else is quite clear. Own consumption. Okay, let's look at depreciation. I don't have to explain. Own consumption 20 by 80 of 220. How do we get that? Here you have to be a little careful. What is the language in the question? Let's look at the language in the question. What does it say here? Notes. Yeah, this one, number 9. Imran appropriated trading stock costing 220 from the business. This is not allowed, okay? This is to be added back. Any appropriation of, just like income, salary paid to owner, that's not allowed, okay? Then, so anything that he took from the business, you have to treat it like a sale. If he takes any inventory from the business, you have to treat it like a sale. And sale at what price? If you're doing cash basis, it is a sale at cost price. But if you're doing accruals basis, it's a sale at market price. You have to remember the distinction, right? You have to add it back in both cases, but in the case of cash basis, add back sale at cost price. In case of accruals, you have to add back sale at market price. We are doing accruals, so we have to add it back as a sale at market price, all right? Now be very careful about the information given in the question. See what is given in the question? He took stock worth 220. That means costing 220. That means it carried at cost at 220. But he also paid 220 of his money into the business bank account. So he's already paid for 220, right? But now we're doing accruals, so we have to register a sale. So what we already have in the accounts is a sale registered at cost price. Do you understand? So, but that's not good enough, because accruals basis we have to register it at market price. So what we really have to add back is the difference between the cost price and the market price. Do you understand? If he's already paid the cost price and we have to actually reflect the sale at the market price. We just need to add back the difference between the cost price and the market price. Is this clear? So for that we have to find out the market price. Now why are they doing this 20 by 80 of 220? Let me show you the proper method so that we have, okay, now where is this? Yeah, under general. I'll try to copy this somewhere here. Maybe I can copy it into your, I should actually copy this into the, into your topic 4 notes. And then we can just write it against, we just copy it into your topic 4 notes and talk about wherever it is, I don't know where it is, where we have discussed the section, question 9.7 elements. Okay, I'll just write it here, okay? As long as it's there, that's what matters. Question 9.7, Imran. Okay, 9.7 you already know, that means chapter 9. Okay, so here I write down this part. Hopefully it goes clearly. Okay, right, I hope the numbers are clear to everyone. Okay, we can make it slightly bigger also actually. And just go back and make it slightly bigger. And I can increase the font size, make it maybe 18. Yeah, okay, that'll make it clear. Okay, what are we doing? So, what is the information in the question? Imran appropriated trading stock and paid 220, so we need to only add back the difference between the selling price and the market price. So that's the gross margin, okay? Now they'll give you some language. Watch out, the ACCA language is very standard. So when you need to get used to the ACCA language, which is gross profit percentage on turnover is 20%. Gross profit percentages on turnover is 20%. Now, do you think turnover refers to market price or cost price? Yes, Aili? Cost price? You think it's cost price? But turnover refers to market price or cost price? Or let me phrase it this way. Does it refer to selling price or cost price? Turnover will refer to selling price or cost price? Yes? Anybody? Turnover will refer to selling price or cost price? Has to be selling price, correct? Because that's how you calculate turnover. Selling price into sales volume is your turnover, correct? So it is selling price. So selling price is basically market price. Do you understand? Do you agree? Selling price is market price, correct? Selling price is market price. So what you have is your gross profit percentage on turnover is 20%, which means that your gross profit is 20% of your selling price. Is this clear? Are you following? So you have to read this language and understand it. So what does that mean? If your gross profit is 20% of your selling price, and what is gross profit? Gross profit is the difference between the selling price and the cost price. So if you take the cost price and you add the gross profit, then you will get the selling price. Do you understand? Yes? You agree so far? Are you following? Okay, so what can I write based on the information? 20% of the selling price is my gross profit. So I can write that point, if I take the selling price as P. Let's say P is price, selling price, and C is the cost price. C we already know, C is 220, right? C is 220 here, from here, cost is 220, right? So C is 220. So can I write P times 0.2 plus 220 is equal to P? Can I write that? Because cost price plus gross profit is equal to selling price, or P, right? So it's like, so you can understand cost price plus selling price. We can write this way. We can write also this like that: cost plus gross profit equals to selling price or market price. Is this clear? Are you following? This is the basic theory. Cost price plus gross profit is equal to selling price, and then you can write it the other way. Selling price minus cost is equal to gross profit. Yes? So selling price is equal to market price. Why do we need the word market price? Because the rule for accruals is you have to use the market price. You have to, if the owner takes stock from the business, you have to register it as a sale at market price. Is this clear? Okay, under accruals basis. So now, so far everybody is following. Do you agree with this? P into 0.2 plus 220 is equal to P. Yes? Okay. That means that 220 is equal to P times 1 minus 0.2. Okay. Is that clear? This means that P 220 is equal to P times 1 minus 0.2. That means that P is equal to 220 by 0.8. Yes? Right? So that means that P is equal to 275. Yes? Okay? So you just divide, you get this. Okay? So then 220 by, so therefore 275, what is 275 equal to? 220 plus 55. So 220 is already reflected in the accounts because he paid 220 into the accounts. So what we have to add is 55. Is this clear? Are you following? Because we have to reflect a sale at market price. So now you see why they have added own consumption. Why did they add 55? Because that's the gross profit. 220 is already reflected in the accounts. You just add the gross profit. That means now the treatment is reflecting the sale at market price. Is this clear? All right. Okay, what else do I need to show you? I think everything else is done. So I have taken about 15 minutes extra. Okay, so everything else is quite clear, I think. Then you have to add back less non-trading income. Where is all this coming from? It's there in the textbook also, but it's coming from the slide number 12 of topic 4. This gives you the basic format, so keep this in your head. Keep this map in your head. Start with the accounting. It's all logical, but it's good to keep it in your head and then understand why it's logical. Deducting everything, expenditure. Why are you taking out non-trading income, bank interest, dividend income, all this stuff? Why are you taking it out? Because the goal of this is to reflect, this number has to reflect, the TATP has to reflect the true income from the trading activity. So bank interest, dividend income and all this is not trading income. It's a non-trading income. We will strip it out and we will charge it separately under our standard pro forma. Is this clear? Are you following? Okay, so that's why we are trading out. What is it? Non-trading interest receivable, surplus on sale of office equipment. This is basically a it's a capital expenditure. So anyway, it's not a trading income. So therefore, you take it out. Okay. So take out all these amounts. Then allowable expenditure not shown, lease premium we have already shown you. Trading profit before capital allowances is this one. This is the answer for question number 9 points. So 10,691 is the answer that you get for Imran, what they're asking you to do. And now one more point, I tell you, I want to just highlight one more point. So there is some confusion about this treatment is not consistent. TATP, what I have taught you is actually the right way, which is that TATP minus capital allowances. That gives you the trading profit for taxable. This is the taxable trading profit. Okay. So the point is that as long as you have information in the question about some capital allowances, capital allowance, here there's no information on capital allowances, and they're asking you to calculate trading profit before deduction of capital allowances. So they're asking you to calculate the TATP. But sometimes people they already deduct the capital allowances and then show the TATP. It's not consistent, but actually TATP should not include capital allowances. After that, you take out capital allowances and then get this. But the point is, that's not so important. If you have any information, here there's no information on sale of machinery and all that, bought this car, sold this car, emission this much. There's no such information. If there's information on capital allowances, then you must straight away write a separate calculation for capital allowances. Is this clear? Okay. Now, whether you write TATP including capital allowances or after that you deduct the capital allowances, it doesn't really matter as long as you deduct the right amount for capital allowances, and follow the pro forma, main pool, special rate pool, all this stuff. Remember the pro forma for capital allowances? Follow the pro formas which are shared with you, yes? And follow that format. Is this clear? Okay? Follow the book and yeah, okay, so I think that does it. We have covered everything. The whole discussion of question number, yeah, that's fine. Okay, so this is basically, but it doesn't really matter, but anyway, as I told you. So I think we got all the answer elements, so you got the trading profit for this guy, okay. All right, okay, so that's it. Now I have taken a lot of time. I've taken almost 20 minutes extra, but it was important actually to cover this because this calculation and all these elements are very important. So I'll just quickly take your attendance.